In this section, we'll go over cash flows from operations, or also known as cash flows from operating activities. To do that, we'll go into what are cash flow from operations, why are they important, and then how do we use them. So cash flow from operations indicates the amount of money a company brings in from its ongoing regular business activities, such as manufacturing, selling goods, or providing a service to customers. So why is this important? Well, it provides an indicator of health for the core business outside of other discretionary options that the management may make, and then informs management on what kinds of commitments can be made to growth, such as what is known as cash flow from investing activities, like buying new property, plant, or equipment. And then we'll go into how to use cash flow from operations. In this example, we'll just go through a section of cash flows from operating activities. As you'll notice, you have cash from customers. So this isn't just the revenue you've produced that you receive in your accounts receivable. This is actually the cash that you got from those customers. There's cash paid to vendors. And again, this isn't including those accounts payable. This is just the actual cash that was transacted during that time. And then the only one that is a bit discretionary that we keep in the cash from operating activities is cash paid on interest. You'll remember from your income statement that interest is actually below our operating expenses, but in our cash flow statement, it's considered part of the business, because if you don't pay the interest on your debt, then those debt holders can acquire your business, so they become an integral part of your operations. And so with this, we'll notice that the first 2 years, there was actually a positive cash flow from operating activities. And then there's a negative year in this last year of 2024. This could be due to some sort of agreement with the vendors on how they purchase them and their accounts payable. There could be a number of different things. It could be just the business is growing, so they're having to buy more resources through this year, and maybe in 2025, which we don't see, there's a increase in the customers buying. Maybe they're just expanding. So this operating activities just gives you a snapshot of this business. There could be other things, like I said, in the cash flow from operating activities that may be financing this 2024 expansion. But yeah, this at least gives you that snapshot of what is happening with their customers, their vendors, and then that interest expense.
My name is Rick Haskell, and I'd like to thank you for watching this video as part of the Bill and Vieve Gore School of Business's Business Certificate Series. I'm a finance professor in the business school, where I'm also the director for the college's Center for Financial Wellness. The Business Certificate Series is offered through the Center as part of our outreach through the Gore School of Business. You can follow us on social media through Westminster's Instagram, YouTube, LinkedIn, or Facebook pages. You can use the QR codes provided or simply go to these websites. Thank you.